Welcome to FinTips, everybody. How you doing today? Hope all is well with you. Happy Friday. We're going to talk about diversification versus correlation. Huge difference here, and I want to try to do like we do and like visually show it so you can get what I'm talking about. Because I mentioned this before, and people go, it's some garbage voodoo stuff you're talking about there. But we manage our own funds here, and so that's important to us, is not only to be diverse, but to have a lack of correlation to everything we're invested in. And a great example actually is like someone that says, I have the S&P 500 iShares, Vanguard, Schwab, whatever, ETF in my account. But I like Apple and Microsoft and Tesla and stuff, and I want to own some of that. Well, okay, you're diverse initially, but now you're overlapping, and so you're more correlated to the S&P than you were before. In other words, you're going to be moving faster than the S&P, which nobody minds on the way up, but you mind on the way down.
Yeah.
So I want to talk about some of those differences and share that with you here along the way. And the easiest thing I can do, by the way, the heck is that?
Yeah.
Is
Chaz, FinTips.
Is that not like the heart and soul of what we are? I mean, that is something.
I do like it.
Handmade by Kevin.
Shout out, Kevin.
Okay, so the first thing we're going to do is we're going to look at the correlation between the SPY, which is, if you knew, it's the original ETF, the very, very first ETF, granddaddy of all ETFs, and it's based on the S&P 500. So we're going to compare the correlation between the S&P 500 ETF and the S&P 500. So do you think that the SPY is highly correlated to the S&P?
Absolutely.
Okay, that's an easy one. In fact, on the screen here, you can see it is perfect. It's a 1 for 1. And when you see the number 1, that's 100% essentially.
And I'm trying to think of a way to put this to really break it down, like correlation. Like It's basically just, a lot alike. So for somebody that's watching that's like, oh gosh, these terms are like so confusing. So they're basically like-kinded. So, S&P 500, the SPY, ETF, they're just alike pretty much. I mean, there's not much difference there.
An extremely small, like fee-based difference is really all it is. But when one does this one's going to do it at exactly the same time. So they're going to do this over and over again.
Yeah.
Whereas if you were to say, especially this year, the S&P versus the Russell 2000, you have the S&P doing a little bit to the upside here and the Russell going a little bit in the opposite direction. So it's not correlated at the moment.
Yeah.
A really, really great example is if we come over and we say, let's see the correlation between gold and the S&P 500, right? So I put the average on there as well.
Yeah.
So the average correlation is 15% of the S&P. In other words, if the S&P is going nuts, the gold will drag behind by about 15%. And you can actually see the zero line here, where there are times, a lot of times actually, the further back you look, where gold is negatively or inversely correlated to the S&P, meaning they're going opposite directions there. Yep. So if you wanted to be diverse and you believed in gold and the S&P, then you would say, okay, that's a way to be diverse, but not correlated. So you would experience times where the S&P is doing the heavy lifting and your gold is sitting there doing nothing. Here's a great example over the last 3 years. You can see the S&P at times has this nice great uptrend here, but gold is just essentially flat.
Yeah.
Over the last 3 years, gold has returned 14%, but the S&P has returned 51%. And again, many times where there's a spread, so that, you got gold going one direction and or the S&P going one direction, gold not. At the moment, if you were to compare a stock, you're going to find it. I don't want to show it because you're going to find that there's almost no correlation between the stock in an S&P and the S&P. And that's because the S&P is just going sideways. When that happens, you can get kind of, a little bit of false readings there, but
right.
So careful on that one. Okay, so let's look at another one here. So I'm going through asset classes.
Okay.
What is real estate? How does that correlate to the S&P? So on average, it correlates about 85% to the S&P. So if you had real estate and the S&P, you still have a pretty hefty participation in the market. Now, this is what I'm talking about. See right here in the last month and a half, we've dropped down to a 50% correlation. The only reason that has sharply fallen off the cliff in the short term is because the S&P is not moving at all, and neither really is real estate. But that's why we don't look at a 1 month correlation. You want to at least look back a year and say, well, how correlated is it?
Yeah.
So on average, 85% correlated. Lastly, I'm going to look at emerging markets. There's a lot of people bring this up every now and then. A great way to be diverse, but also not correlated to the S&P. So the average here is about 60%. And there are times where, yes, emerging markets can be inversely correlated, in other words, doing this thing, to the S&P. I fear that there will be times coming up where there will be an inverse correlation to the S&P versus emerging markets. I think you just had a client ask about that.
Yeah, she did. Yep.
And so that's what that means. And so it's very difficult if you say, I want to have these stocks, but I still want to have long-term investments. Now, we're not the type of advisors that say, we're only interested in your investments. Right? We look at your net worth. We want your whole net worth to, don't look shocked. We want your whole net worth to grow. And if that means that this account needs to be here, this account needs to be here, and this one needs to be here, so long as they're not all correlated to the same thing, then we don't have to worry about the markets falling and you calling going, why is everything that I have falling at the same time?
Yeah.
Lastly, we do have a client that said that. And you do know this client.
Why is everything falling at the same time?
No, not that said that, but that said, not only do I want growth, but I would like to have these positions. And I want to reduce the volatility as much as possible. And for the first time ever, they said, here's a list of stocks that I want to be in. You do what you have to do.
Yeah.
And I was like, Kevin, no one's ever said that to me, but all right, let's do it. And so we built a custom portfolio for just them. And I came back and look what we have here. We have a 96% correlation to the S&P. Well, that solves question number one. He wanted as much growth as possible given only these stocks to use. So I said, I could do that. I'll make that happen. I'll put X percent in this one, X percent in that one. I played the game and found out I could get him to 96%. But what's the bad news? He's highly correlated to the market.
Yeah.
So the volatility is, that's the best I could do, is I could just get it just under the market, except for now, of course, you're seeing on the screen the market going sideways and the impact of that. But his average is going to be right there with the market. So can you have extremely low volatility but high correlation to the market? Not really.
Yeah.
It's incredibly difficult, especially since you can't really use bonds to slow things down these days.
Well, and that's what I was about to mention was the bond side of things. And generally speaking, you've got your bonds that aren't going to correlate with the market because it's bonds.
Yep.
But in 2022, as you saw, the markets fell, the bonds fell. Oftentimes, bonds work opposite of the markets.
Only 4 times in history that's happened.
Yeah, and so it's. I mean, that's oftentimes why you hear, oh well, let's put 40% bonds in here, 60% stocks, because no, the bonds aren't going to go up with the markets, but they're not going to fall like the markets either. They're not correlated, or they're not a lot alike, or alike at all. But in 2022. Unfortunately, that was just the opposite because as the Fed raised rates, you've got bonds falling. You have the bonds that were already out there because they're not attractive. People don't want to buy them. And then also you have the stocks falling. And that's where when you open up your portfolio and you're like, dang, I was 50-50, 50% stocks, 50% bonds, and I'm still down almost as much as the market. That's why.
Yep. Highly correlated. But now that's an outlier. So don't operate going forward thinking, well, having 60% stocks, 40% bonds is highly correlated. That would be one that if we put that on a chart, you would see, it's really correlated through the month or year of 2022, but otherwise it's way down here. You're more than fine.
The schooling that, I remember that from forever ago, going through and getting licensing and like having to learn all the different stuff. That was a big one that they taught, how they don't correlate, how it's so different. And it's like, put this one in the history books for 2022.
There's so many things.
Learning lesson.
I can remember in high school, our economics teacher, he's like, real estate prices don't go down. Like the industry around here is fine, it's growing. He goes, you one thing you need to know is you go out and you buy real estate and you'll be fine. And coincidentally, a couple years later, not a couple years.
That's where you start to realize the indicators, because I was the same way. My uncle told me, he was like, best thing you can ever do is buy real estate. And that was beginning of 2008 when I bought my first house.
Yep.
And
long term, sure.
And so it's funny to see that. And it's same though with 2021, when everybody was out there just making crazy money and buying any stock and it was just making money. And everybody's like, oh, we can do this. Oh, go buy this, go buy that.
Yep.
When you start seeing those kind of trends, that's when you start to say, something's not adding up here.
That was a side note thing. That was a hell of a time, because when we have so many clients that when there's some sort of phase or something going through the news, we tend to hear about it. Yeah. And everybody was like, Dustin, I'm killing it, man. I'm selling my options. I'm killing it. I'm buying stock, AMC, this and that. And I'm like, ooh, I don't like the taste of that. You know, it shouldn't be that way. But it's what it is.
That's it. Well, so let me try this. I'm going to see if this works, because this isn't my normal.
By the way, I want this on record.
My normal one-liner. Look,
I'm drinking water.
Yeah, I'm proud of you.
It's water.
I'm really proud. You know, my wife does that. She used to like the sodas, so then she drinks the bubbly water or whatever. Yep. You know. So make sure you go buy bubbly. No, just kidding. It was nothing sponsored by.
No free sponsors here.
No. So all right. So, years ago, I had my first big interview, and I'm like, I'm going to this interview, and I realize, oh my gosh, I can't tie my tie. And so I realized my dad was already gone to work. He couldn't tie the tie for me. I didn't know what to do. So I'm walking, and I'm going to this interview, and I see this crossing guard out there. And I'm like, hey, excuse me, sir. I was like, by any chance, could you help me tie my tie? And he was like, well, sure. He told me to lay down on the park bench. I'm like, well, that's kind of weird. I didn't say anything, but I'm like, you know what? If this guy knows how to tie a tie, I'm going to lay down on the park bench. So I laid down on the park bench, ties the tie, and he, shows me. He was like, here, check it out. And he pulled out my phone and showed me, took a picture of it. It's like, there you go. And I'm like, nice tie. And I was like, all right. So then I was like, why would he have said that? So then after the tie was tied, I was like, all right, so why exactly did you have me lie down? He said, well, that's, how I used to have everybody, that I worked with back in the day. Everybody would have to lay down. I would tie ties on them. And I'm like, what did you do? He said, I ran a morgue.
Now, okay.
That was a deadly joke.
Okay.
So I don't know. I wanted to try something different, and I was looking. I was like, I actually loaded this thing up, and I'm like, all right, I'm going to try to read through this. But I was like, I can't read through it. That would be awful. It would take away from everything. So yeah, it was there.
You think when they asked George Washington for an ID, he just pulled out a quarter? He couldn't decide something. He's like, call it. Me or tails.
There you go. But is he on the quarter?
Yeah. Who do you think's on the quarter?
So,
don't give me the Abraham Lincoln thing. Come on.
Just be like, who's on what here? Let's actually think through this whole thing.
Quarter man.
The quarter man.
I love it. All right. Well, have a great rest of your weekend there. And thanks for watching everything. Adios.
Adios.